It's
a compliment.
Okay, well, let me know when we're good to go. We good?
Yeah.
Okay, well, I guess first of all, welcome and good evening. We are Freedom Cobra Consulting, and we're happy to have you here this evening. First of all, we are looking at your brand, the Pop Shop, as you know, and the potential of taking this forward to market. So we've come to you today, how do I move this forward, with the following recommendation. First of all, we do want you to launch your brand. We want you to take this forward because not only is there a sentimental attachment, but we think there's profitability in this venture. Secondly, signing with the strategic distribution agency to lower your cost of production and to streamline the ease of getting this product to market, but also forming a strategic partnership with Second Cup. You'll see the logic behind this soon, but we think it's a very attractive venture to get into the market and ease distribution. Also with that, we want an unconventional, high-energy marketing strategy. You're not a Coke or Pepsi. You don't have tens of billions of dollars to play with. You need something that's different. You need something that's going to get you out there to a different type of consumer group. So first off, we're not going to give you much background because, I mean, you know your company better than we do. But as a bit of an overview, we want you to take these things into consideration as we move through this presentation to you. Now, first off, the nostalgic value of the brand. This is an important selling point because wherever we take this, and you'll see in our strategic partnerships, that the nostalgia of the brand is what brings our two target groups back. Our two target audiences being baby boomers and being hipsters, which Matt's going to get into soon. Also with this, we think there's an opportunity in the premium pop market. Right now, the regular pop market's extremely saturated. As you know, between Coke and Pepsi, Dr. Pepper, Schweppes, and Cod Corp, you're looking at close to 95% of the market share. There's not a lot to move into this, and this isn't even including companies like Jones and Stewart's. Beyond that, one of the most important things to take away from this slide is making the same mistakes as last time. We know that most businesses fail in their years of the most growth and revenue. Why is this? Because they expand too fast to keep up with the means of production and with distribution. In doing so, internal efficiencies can't keep up with what has to be done to sell the product and what has to be done to keep the company solvent. So we want you to consider that we have a slow expansion plan, something that's going to prevent from that happening in the long term. When VentureAct took over, they made decisions that were irrational. We also want to look at brand inconsistencies. Valuing your brand once again as a discount brand isn't going to sell in the current market. It's too saturated. It's a red ocean. We need to look at brand inconsistencies and create one streamlined premium product. So today, just to give you an external analysis of this, we tried to take an internal viewpoint, but because we found that pretty much all you're working with for a resource is the brand, that it's important to look at the outside of this to see how we can get back into it. And you'll see that as we've got this listed, extremely high challenges coming forwards. First of all, competitive rivalry. Don't need to tell you, but Coke and Pepsi are major players. They have the market saturated. Beyond that, threat of substitute products. We're now coming into a time when health is more important. Energy drinks, Red Bull's starting to take the market, and there is substitute brands out there that'll take away from pop sales. There's also the push for things like water and juice, which is great for that healthy market, but not great for the pop shop. When we look at the threat of new entrants, we see this as low. As been identified, high capital cost to move into this, a saturated market. It's going to take something special to get in and differentiate yourself. Also, the bargaining power of both suppliers and buyers. We've identified both as high. Buyers, there's a lot of different decisions they can make. They're able to decide on emotion. Coke and Pepsi, there's not much of a difference in taste. The difference in this market is emotion. It's what your sentimental ties are to, what the childhood memories are built on. And you're going to see that the childhood memories of that baby boomer generation were built on the pop shop in Ontario. And we're going to be able to leverage that aspect. Also with that, bargaining power of suppliers. The high capital cost, the difficulty of getting into the bottling process, also the distribution, extremely challenging. Suppliers have a lot of control in this industry. So we want to differentiate yourself so you're able to move in there to a smoother process. So I guess passing it off to Matthew to talk about our target market.
Awesome. Thanks a lot, Adam. So basically we have two separate but distinct groups here. The baby boomers and their kids, the trendy hipsters, the ones that are in university now. The baby boomers are an incredibly interesting market because they're incredibly large, obviously, and right now, I mean, you see it, all the commercials are geared towards them because they have all the money and they're the largest group. The other thing that happens with baby boomers is it always seems like they're going after their glory days and they're in their 20s and, you know, things are always coming back all the time. Bands are coming back like the Eagles, Pink Floyd. In my case, it was Styx. We also see lots of cars coming back all the time. Chargers reinvented, the Trans Am trying to come back. And the funny thing is that baby boomers, though maybe started originally, it's their kids, the 20-year-olds, that ended up taking it up eventually. So our plan is twofold. The target market we've identified hits both the baby boomers who grew up with this product. They have the nostalgic feel. They remember going to the corner store with their friends on a Saturday, meeting up for a couple pops. And ultimately that experience, they'll introduce their kids to that product, and that's trendy hipsters. These people are university educated. They're generally in their mid-20s to early 30s, but we also have some people that are probably potentially in high school as well. The plan here in our marketing strategy, which Adam will talk about in a little bit here, is to fuel directly into the baby boomers, which will in turn hit into the trendy hipsters. So moving on here, the decision criteria that we based things on today was based on these 5 separate entities. First of all was feasibility. How are we going to do this? How easy or how hard is it going to be to break in? Second thing is profitability. Ultimately, what we're here for is to make some money, and we want to make sure that that's happening for you today. The third thing is distribution capability, which ties into the second point very importantly. How are we going to get this product distributed to our clients, and what's the best way to do that? Fourth of all is brand consistency. Having an important brand is ultimately the most important part of this whole plan. Brand equity is the single asset that you have, and it's the single thing that's going to allow you to sell more product. So keeping in with our brand consistency will prove absolutely essential, not only now, but 5-10 years down the road. And fifth is the accessible consumer profile. I've already identified that already. We're going for the baby boomers first, and then tying right into their kids, the trendy hipsters. So the distribution alternatives that we came up with, how are we going to get this product out? Basically, there's 2 kind of main alternatives that you have here. First being the real estate ownership, which is has its pros, and the second one is the distribution agency. So I'm going to go into the real estate ownership right here. Ultimately, that's going to give you more internal control. It's going to allow you to control the product at each stage of the product life cycle. But ultimately, it's a little bit tougher to implement because it's so expensive. Real estate in the markets that you're looking at for the square footage that you are going to need is going to run you into the multi-millions of dollars in capital expenditures. Pricing it out, even renting, is going to run you at least $1 million a year, and that's just for the property. Distribution agencies, though, on the other hand, they have the warehouses. They're all throughout Southern Ontario, across Ontario, Western Canada. It's a lot easy. Problem is that it's a little bit more expensive in terms of it's going to eat into your margins a little bit more, so that's something to take care of. Ultimately, our suggestion here today is to go with the distribution agency, and then maybe look at doing the real estate ownership a little later on when you're a little bit more established. So the sales alternatives is also very important. We see 2 different parts here. Discount carriers being the first one, and the boutique retail being the second one. Boutique retail, of course, including Second Cup. Discount carriers are interesting because you get large volume, large sales, but it devalues the brand. And like we talked about already, brand equity is the single most important thing that we have here, and we have to leverage that. Boutique retail is a little bit better. You have the unique consumers that we want, the trendy hipster market, which is ultimately the up-and-coming market where we expect to see our future sales growth. They ultimately are going to these corner stores, they're going to the specialty coffee shops, and we see a lot of potential growth there. It's a lot easier of distribution. Yes, it is a smaller market, but it's a good place to go in first and foremost. Marketing alternatives-wise, we've identified 2 major parts here. Traditional marketing channels, ultimately, you know who that is. That's Coke and Pepsi. We can't compete with them, so why try? Our idea is to go with an unconventional marketing strategy, something that's original, inexpensive, and targeting the specific target groups that we've come up with already today. So now I'll pass it off to Adam to go through our recommendation and begin talking about our marketing plan.
So just to give you a little bit of a refresher, as you can see, like we said, this is taking the brand forward. We did some financial calculations on this to see what the value of the firm going forward is. And right now we know that interest rates are super high. It's 2004, it's a crazy time. But we do think that after 5 years there's going to be profitability in this after discounting back. We also want to point out that that partnership with Second Cup, which I'm about to move into, is really the crux of this presentation. It's very important. So, moving forward. Now, what do Lego, M&M, and Guinness have in common? And we looked at this and we said, they have something that makes the brand a destination. What makes it a destination? Lego. They've got Legoland. Slowly it started as one and it has established itself all over the world. It takes your pleasure of the product outside the bedroom and makes it something tangible, an experience that you emotionally develop. Also with that, Guinness and M&M. People come from around the world to see their favorite brands and to learn a little bit about it, but also to develop more of an emotional tie and a long-term sustainable approach with their buying behavior with the product. Now, what we've proposed is a physical pop shop. Now, we knew originally back in the 1970s there were pop shops, but they came at it from a different angle, because these pop shops were designed just as distribution slots because they didn't go through the traditional means. This pop shop is completely different. We're looking at positioning this in Parkdale in Toronto, one of the trendiest areas we can find, where you're seeing a lot of people in the baby boomer generation, but you're also seeing a lot of those trendy hipsters. It's somewhere that they can hang out, but you also draw a lot of tourists to, so it becomes a destination for people across Canada, which is very important for expansion of the product into the future. You'll recognize that it's going to be a very nostalgic feel. We're taking you back to the days of the soda pop shop. Think Archie comics, that kind of feeling of going down with friends, hanging out, something that's going to rekindle those times for the older generation, but also creating a new what's different for that trendy group. You have to remember, the trendy hipster population is called the hipsters because they want to do what's hip, what's different, what the rest of the group isn't going for. That's what this is. The pop shop isn't Coke, it isn't Pepsi. It's a unique product that you build an emotional connection to. Now, also with that, I want to point out the original bottle return system. This is something kind of interesting. Now, we recognize in the past that it's the 1970s, it's easy to do, but like milk at your door, some things have gone in past. We want to bring this back, not only because it's a cool nostalgic value, but from this one location, we're able to sell the greener side of things. That hipster population, very into sustainability, very into the future of this planet. This bottle return system can be sold as a green piece, sold as recycling, and it's also going to cut costs at the end of the day for us because of the expensive mold of our bottle. Now, as far as the marketing plan goes, we recognize that we do have to do a little to get the hype up. So as far as the pre-launch and the launch goes, we've looked at creating hype at universities, where a lot of those hipsters come out of. So this is going to be sample products. This is going to be, we know guerrilla marketing is just a buzzword, but in this situation, guerrilla marketing is a lot more than that. We're going to have retro outfitted people coming around selling the product because it's something that encourages that nostalgic feel. And to that hipster, this is something different. It's something they can go after. It's a market that isn't the traditional means. Now also, at the same time, developing a business profile downtown. And that profile is going to those baby boomers. Where do they work? You have a huge mecca in downtown Toronto, a very large population, and hundreds of second cups scattered between different buildings. They have the ability for direct access right there to move into it. And you'll notice that we also want to move into lunchtime giveaways in downtown. Now, also looking at this marketing effort, so this is print ads, things like in subways, around universities, just so people can keep the product in their mind, but from a very cheap standpoint, just to hit that accessible customer profile. Now, the product itself markets itself, and this is where I want to talk a little bit about Second Cup. The idea behind Second Cup is it's a Canadian player that has a unique image. It's not a Starbucks, it's not corporately owned, it's franchised. And what else? Right now, Starbucks hasn't been able to make much of a move to Eastern Canada. They're still trying to play out with the Western Canada side of things in 2004. So this product has the potential, and a very similar logo to the Pop Shop of all great things, to do this. Why Second Cup though? Beyond that, they don't have a soda line right now. We saw Starbucks' success with Jones and Jones vice versa. But there is no soda line. There are Italian sodas, something that's not quick and easy to come. If I'm a business person working downtown, I can walk in, grab a pop, come back out again. It's a premium product, it's unique, it's not just going down and buying that Coke, and it's a lot easier. It's also the same type of thing with the hipster market. Going into Second Cup is a lot different than walking into the Max or the 7-Eleven. This is somewhere they can feel as their own, somewhere they build a connection with, and they build a connection with the actual product. I also want to point out that this product, moving into Second Cup, means we control the distribution means to a smaller area. We're able to push the product through without having to go take on an entire sales staff, cut our overhead a massive amount, for having to work with individual clients. A company like Coke has tens of sales reps per city just going out to sell those small contracts, and this is in small areas. We're cutting out that middleman, we're adding to the bottom line, and we're making this more sustainable. Now, I'd also like to point out with the marketing plan, community involvement. We pointed out the concept behind sustainability. This is about getting involved in the community. It's pushing to that group again, reminding them that we're there, that we care, that we're the pop shop. It's something that isn't going to cost a lot of money, and it's going to increase our value in the actual community. So I'm now going to pass to Matt to look at our implementation.
Right, thanks Adam. So before I begin here, just keep in mind everything in this implementation, the whole thing is all fully costed. It's at the end of our presentation. If we don't get enough time though to get into it by the end, please just ask questions and we're pleased to show you our financials. So the first and foremost, the short term. The first thing we got to do is we have to sign an agreement with the bottler. If you remember what I said earlier, the capital costs are just simply too high. We're looking at multi-millions of dollars of CapEx, so we've ultimately decided here to go with the distribution agency, find a bottler, but make sure that we're creating that classic stubby bottle because ultimately we want to build on our brand equity, the nostalgic value. Second thing we're going to do here is we're going to begin our negotiations with Second Cup. Like we said already, Second Cup's a natural fit here. We see a lot of potential here, but we're also going to make sure that we're confining it to the Southern Ontario market. We want to build enough brand presence in Southern Ontario, mostly because it's the main tourist destination in Canada. A lot of people are coming to Toronto for business all the time, and we feel like if we can create the pop shop there as well, people from other places in the world, notably Western Canada and the northeastern United States, will start to experience the pop shop brand and be able to leverage that from there as we go forward. The third thing is we're going to develop a website, a launch strategy and initial marketing materials, and ultimately you'll have to hire someone to do those things for you. Medium term, looking 6 months to 2 years here, we're going to start the development of the physical pop shop, as Adam said. This is going to be a destination product, or destination store. We're going to make sure that we have the infrastructure to do so, and also make sure that we have our pop shop and the physical tourism documents that Toronto Tourism distributes to their hotel guests and to guests from overseas. Second thing we're going to do here is roll out the product. Ultimately, it's going to take quite a bit of time to do the classic stubby bottle mold. We have to negotiate with all of our distributors. It's not going to be just a snap of the fingers to find a bottler and to find a distribution agency. These things take time, they take convincing, and they're going to take negotiations. The third thing is we're going to have to start a co-marketing strategy by the end of the year 2 with Second Cup, or end of year 1, sorry, with Second Cup, and we want to be in all of our stores by the end of year 1. Long-term wise, we're going to expand beyond Southern Ontario, get into the Western Canada, Northeastern United States. United States, like we said, we failed in the US before. That's what brought us under before. We don't want to make the same mistake again, so we're very hesitant. We want to make sure that we do our market research before going there. Second, we're going to explore the ownership of the bottling process and continue our state marketing.
Alright, so I guess, no plan comes without risks, and at the end of the day we have to take in a few important things into consideration before moving forward. So first of all, and clearly most importantly, lack of consumer adaptation. What differentiates this product, and at the end of the day there's a lot of market out there we saw with that Porter's analysis. Now, first of all, we want to mitigate this with that nostalgic value. That's really selling the emotional connection to the product. As we said, the difference between Coke and Pepsi is emotion. Pop Shop can come in and move into that way. Jones has had a lot of success in their sustained marketing by creating a value with sending in pictures and getting them back on your bottle. We have the same type of concept by investing in a company, or by moving with a company like Second Cup, who's also Eastern Canadian, has a similar client base, and has a management team that's very focused on the region. We think there's a lot to that. There's also the consumer-specific marketing. This is looking at that hipster crowd, the sustainability push, the move to a pop that, while the health push is important, it's a little bit different. It's kind of a treat. With that too, the failure to secure the distribution agency. Now, we've been told that distribution agencies are very selective in decisions they make. As far as this goes, we think it is important to sell the value of this brand, not only the value of the physical product, but the ease of the distribution. Working with a company like Second Cup and other small boutiques means that this distributor has lower capital costs at the top of, or at the end of things, but while it's a higher priced product, they're going to be able to take more on it for a margin. So this is a more profitable venture for them, and at the same time, we're still not losing anything because of the nature of the distribution agreement. The last risk, cost overrun. Always a problem with new startups. So we've made a very, conservative budget for what our capital expenditures and initial investment have to look like off the bat. But we also keep that inexpensive marketing strategy. We're not going to drop millions of dollars on this. It has to be unique. It has to be differentiated. It's the only way we can really make it up on the market. The other thing, the small test market in Southern Ontario. This isn't the rapid expansion that happened last time Venture bought the company. This is going slow. This is taking it easy and being very cautious. So to wrap up our presentation here today, just to summarize what we've gone through. First of all, launching this brand. This is more than just an emotional connection to you. You saw it when you looked at the different formulas and the cost it took to make these patents. You're a lifetime entrepreneur. You want that next venture, and you see profitability in this, as do we. We're seeing that with our strategy presented here today. Also with this, the possibility to sign with the distribution agency, cutting into some of the problems with the overhead costs of owning real estate, owning the means of production, and looking at a long-term sustainable solution where we can own the own means in the future. Also with that, the partnership. We've talked so much about the value of second cup. We want you to consider this and also the boutique market because it's something that differentiates us from using a discount store like a Zellers or a Costco. Moving into something that's going to completely devalue your product and push you into the same basket with the other 20 Coca-Colas out there. It's too tough, the market's too saturated, you need to be differentiated. And the last thing, the energy strategy. Do you count down?
No.
Oh, there's no countdown? Okay, well I guess that wraps it up, and we'll open the floor to any questions.
Can we see the financials?
Absolutely.
Okay, so I guess this is where we've run our marketing costs. We think it's on the high side because of what we're putting forward, but we think it's reasonable to say $140,000 in the first year. We costed this based on how many employees we're going to need on a per hour basis working in downtown Toronto and universities. We also looked at the cost of the physical materials, so we tried to add a little bit of a buffer on top of it just because cost overrun was one of those risks that we identified. Now, further into it, this is the pop shop itself. We wanted to show that it does add to the bottom line. So you'll see here that net income was forecasted negative the first year, but it slowly moves forward, and it builds into that present value we've calculated overall. Now, as far as total income goes, you'll see that that revenue number at the end of that is staggering, but we have to discount at quite a high rate because of what we're looking at in terms of interest rates right now, and also because you're in such a unique market. We're expecting the cost of equity on this project to look fairly high. Beyond that, we have forecasted, not included in this, the initial investment of $5 million. That $5 million includes the molds, 4 products in the starting year costing $10,000 each, rolling out to a potential of 16 at $10,000 a piece. There's also the concept of the actual mold and the owning the real estate of the pop shop. So there's quite a bit that went into that. Once again, we added a buffer to make sure it's realistic. These sales, you're looking at 100 stores at 50 bottles a day for this revenue with, I guess, complete costs in at around 85% of your total revenue figure. So,
if I could just add one real quick add on to that is that the fact of the matter is that interest rates are very high. There's a large opportunity cost to doing this right now. You have to be experiencing returns of around 12% a year to even make this even work feasibly and not sacrificing an economic cost there. So ultimately these revenues, this is what you have to hit in order to even make your capital expenditure back with the interest rates included. So these numbers are A, conservative moderate, and B, you have to make these in order to make your money back, including the opportunity cost factored in there.
And to point out that first volume here on the total revenue, that's under $2 million. It's about 1.5 million bottles, I believe, in the first year, which we think is actually quite a conservative estimate, looking at some of the StatsCan numbers on what it takes to get into this industry.
So you put a lot of weight on second cup.
Yes, we did.
And I'm seeing health trends and energy trends.
Negotiate with you. If you say no entirely, that's when we move to that boutique market. We still identified it as an important one. There are a lot of shops in these areas. Toronto, we know for being a very large market for small coffee shops. And like we said, I guess Starbucks hasn't had the chance to fully move out here yet. That's still a lot of ways to expand our product. At the end of the day, the risk of moving into a discount store is just too high. We're going to devalue our brand. We're going to compete directly with Coke and Pepsi at a higher price point, and it's just not reasonable. You have to really focus on that boutique market to be successful.
How is Brian going to secure the funding for this project, given some of the difficulties that he will have?
Absolutely. So first and foremost, we happen to be finance majors, so we understand what it's like to work with financial institutions and getting the kind of sources of lending. You're going to have to look at venture capital here. Major institutions are not going to accept the type of money that we projected going out forward here with a high market risk premium that this kind of product has. So ultimately it's going to be venture capital. You're going to be bootstrapping a lot of it yourself, and it's going to be all through private equity mostly. Also, lending institutions are also going to look at this and not feel that this is a great place to put all their bets on red. And we're going to have to make sure that debt going forward is an option, but right now it's not.
Just to add to Matt's comment, we know that you're a lifetime entrepreneur and that you have, I guess, quite a substantial amount of money to just purchase the patents for fun. So we know that you do have a lot of, I guess, relationships in the past to make you a successful entrepreneur. And you probably have access to some of those venture capital markets and other angels that are interested in such a sentimental product. This appeals to that angel generation. This is something they grew up with as well. And these are the type of people that can put forward the capital for such a product.